In today's video, I'll break down the anatomy of an intraday reversal trade setup inside of the major index markets. We'll break this down into a simple 5-step repeatable process that you can follow every single time to spot and trade the very best intraday reversal opportunities. Now for today's video, I'll focus in on the major index markets with a special emphasis on the S&P 500. But you can follow the same 5 steps on whichever market you're looking at to again take advantage of these intraday reversals when volatility clues present themselves. Now let's start with understanding some of the common characteristics that take place before these intraday reversals actually present themselves in the market. Number one, which I think most of you are well familiar with, is the idea of an overnight gap. A gap gives us price levels that can act as a magnet where price can either flow freely between or towards. So gaps here are very important where they give us a nice target that we're looking at price action to fill in terms of filling the gap. Another common characteristic, low morning volatility. Now when I say low morning volatility, I don't just mean we're trading sideways here. You might still have fairly large candles, but those large candles are jagged and we don't have any real sense of direction. All we know, or at least you can get a sense of the idea that something is brewing behind the scene and you're waiting for whatever that is to present itself. So here, low morning volatility is a nice clue, especially when you have an overnight gap. Now after that, we have things like scheduled volatility catalysts. You can use Forex Factory here to make the job easier, but focus in on things like key releases, numbers, reports, news events, things of that nature. After that, we look for clues of price stability. Is price no longer making lower lows or lower highs? Are we starting to see things like smaller candles, price contracting, which gives us the idea that either the sellers or the buyers are now starting to lose strength? And finally, the idea of correlated price movement. Are the S&P, Dow, and Nasdaq all moving together? Or do we instead see, say, the S&P and the Nasdaq moving in one direction, but say the Dow in a complete opposite direction? Are they moving with each other or against each other? That's something else that would give you a nice clue in terms of if these intraday reversals will present themselves. Now once you've understood some of these common characteristics, you can then start to apply this 5-step process to actually take that knowledge and do something with it. Now step number 1 is identify those overnight gaps and price levels. Make a note of this either on a piece of paper or even on your chart, but these are going to be the levels that serve as your compass, the place where you expect price to gravitate towards as the day progresses. So that's step number 1, make a list of these levels. Once you've done that, you can move on to step number 2, which is to assess the morning volatility. Now I'll leave a link to a simple 10-minute process that you can follow every single morning, which will make assessing morning volatility very easy. You can very quickly gather, do we have low morning volatility or high morning volatility? The days where we have high morning volatility, you know the notion of these intraday reversals is less likely compared to the days where we say have low morning volatility with an overnight gap in play, which is setting up for really a nice storm that you can take advantage of. So that's step number 2, follow the 10-minute morning volatility process, understand which volatility models are being used, and if we have low or high volatility to start off the day. Now once you've done that, move on to step number 3, which is make a list of the volatility catalysts that are in play for the day. Is there something that's going to move markets, or do we rather have unscheduled volatility catalysts that we're going to be relying on? There's a difference there, but if you already know right off the bat that, hey, X, Y, and Z events are scheduled, that makes your job a little bit easier. Now step number 4 is where we start to dive into the actual setup, which is waiting for price action to either rally or sell off into our key volatility levels. The goal here is to be patient and wait for price action to come to us. We're waiting for our volatility box levels to be breached. These are the cyan lines on the Futures Volatility Box models. We're waiting for the cyan lines to be breached, and when that happens, make a note of which markets are being breached. For example, today we had the S&P, Dow, and Nasdaq all breaching our volatility models in the 7 to 8 a.m. Pacific hour, but only the S&P and the Nasdaq actually gave us entries. So while these levels may be breached, you don't necessarily have an entry in all of the markets. So wait for that, be patient and wait for price action to come to us as opposed to chasing price action for some of these intraday reversals. Finally, step 5 is the easiest step of them all, and that's where you're simply waiting for an oversold or an overbought confirmation signal. An oversold signal is one in which price action is sold into key levels. We wait for a green arrow, and that's really the final step that tells us that, hey, we're officially in oversold territory. For overbought, that's the exact opposite. We're looking for a red arrow, which tells us that, hey, we're now waiting for price action to stop rallying rather, and for sellers to come in and to move price action down lower. Now let's apply these 5 steps on the S&P today, step by step. Let's start with step number 1, which is identifying our key overnight gaps and price levels. Here's the SPY ETF. I think this makes it very easy to spot the gaps. We can see yesterday's close here, and we can see this morning's open with price activity. In between these two prices, we have a gap, and this is where price can flow freely towards and between. So now we have a baseline compass that we can use for our navigation. We move on to step number 2, which is assessing morning volatility. Now here's the morning volatility note we sent to all of our Futures Volatility Box members this morning. This was sent at 7:25 a.m. Pacific, and this very clearly tells you what each market is in terms of volatility box models. Now we're paying attention to the S&P here, so that's ES Futures, where we can see the S&P, the Dow, and the Nasdaq were all on their scalper volatility box models. We have 5 models. You can see them down here. Think of this as a ranking system from 1 to 5, 5 being most conservative, 1 being most aggressive, and in today's case, to start off the day, all of the major index markets were on the most aggressive volatility box models, which means low volatility to start off the day. So far, we've understood overnight gaps, and we also know we have low morning volatility. Now we move on to step 3, which is understanding the catalysts for the day that are scheduled. We pay attention to the red folder events, and there were 2 today inside of the broader markets here. One was non-farm, which was before the market opened, but the second one was in play after the market opened, 7 a.m. Pacific, and that was ISM numbers. So now we have a scheduled volatility catalyst event as well that can move markets. Now we move on to step 4, which is waiting for either a sell-off or a rally into our key volatility levels. So this is a chart of the S&P 500 on the scalper volatility box models, 1 minute time frame from today. You can see here early in the morning, price just chops around sideways, but we have some fairly large candles. 7 a.m., we have the volatility catalyst of the ISM numbers, and from that point, we have a sell-off into our volatility box models. For our fade setup, we're looking for the cyan line to be breached, and that cyan line gets breached with this green candle here first. Once that green candle crosses the cyan line, we've officially hit our volatility levels where we now know we have an edge. So we're waiting again for price action to sell off into these volatility levels before we do anything with regards to trying to trade these intraday reversals. Once price falls into our scalper volatility box models, we can now wait for step number 5, which is waiting for our oversold, overbought confirmation signal. In this case, oversold, the green arrow. That green arrow comes when price action breaches the cyan line, and we have the green arrow suggesting that, hey, we're officially now in oversold territory. We're looking for price to reverse away from the volatility box levels, and we have our overnight levels way above where price action is currently trading at as a potential magnet for a really nice intraday reversal. Now, applying these simple 5 steps across the board here, this is what happened in the major markets today. Inside of the S&P 500, we had 2 trade setups. Both were winners, and you were able to pull out 36.5 points from the market. Really nice, hefty P&L number there. This is again using the full-size contracts. Pay less attention to the numbers there because you could divide this by a 10th for the micro contracts if you have a smaller contract, or even trade something as small as, say, 1 SPY share, really looking at moving in the pennies here if you're really just looking to practice and apply these principles before you start to layer on risk. The NASDAQ, 1 trade there inside of the NASDAQ, much bigger risk inside of the NASDAQ, which paid off today. Again, all 3 of these markets moving together. The Dow was the odd child out here, 2 trades, 50% win rate, 1 was a loser, but that loser cost us more than the 1 winner made us, and the day was a net negative inside of the Dow futures market. Now across though, we still ended with a positive P&L here, and that's the thing to take away. It's the idea of applying the systematic process every single time into the major index markets and really letting the probabilities work themselves out for you. Now let's take a look at each of these three markets here inside of our Thinkorswim charts so you can get an idea of how that reversal actually looked like on the Thinkorswim platform. So this is the S&P 500. If I maximize this and we zoom out, this is what the day looked like here. Now our overnight gap where we had, let me change this to a 5-minute so it's easier to see. This is where we had our overnight gap that we pointed out from yesterday's activity, this price level right here. Now we can see what happened as price action reversed. We were looking at price right here, and that intraday reversal took us all the way to a really nice gap fill inside of the S&P 500. Contrast this with the Dow here. The Dow, same idea. Price fell inside of the volatility box zones in the morning, and then we rallied into the day, filling the gap that we had from overnight activity. And finally, the Nasdaq, same idea here as well. The Nasdaq looked a little cleaner in my opinion out of the bunch. The Nasdaq, we had price fall inside of the zone, looked about the cleanest in terms of the reversal, but here the Nasdaq stayed true to its name of being NASCRAC instead of Nasdaq, where even the initial risk required was right around 38 to 40 points on the NQ futures here. So it's not a trade for the faint of heart, keep that in mind, but you do have ways to mitigate that risk by using things like the micro Nasdaq futures or even things like the QQQ ETF to play these moves in lieu of the futures contract, again looking for this gap to get filled when we have price bouncing into our oversold, overbought areas along with our volatility box zones. Alright, I hope you found this video to be useful for those of you looking to try and take these intraday reversals and boil them down into a simple 5-step process that you can follow every single time. One more time to recap the 5 steps. Step number 1, identify the key overnight gaps and levels. This really gives you the magnet that you can use price to gravitate towards or away from. Then assess the morning volatility. If you have lower volatility, I think that leads to nicer opportunities for these intraday reversals, and it also allows you to have lower risk involved on the trade compared to if you had greater volatility. We then make a note of all of the scheduled catalysts for the day, and once we've done that, you're now being patient, waiting for price to come to you, hit our key volatility box zones. Once that happens, we wait for the edge signal confirmation, and after that, let the trade manage itself. I'll leave a link to the fade setup as well, which I've glossed over in this video, trying to focus more on the process here, but the fade setup will go into the nitty-gritty of the setup here, really diving into steps 4 and 5 in a little bit more detail. Alright, take care everyone, good luck trading, and I'll see you in the next update.